Thank you for joining us and welcome to tonight's webinar. Today's topic is how to be the bank. For your questions, please type them in the chat box and that will be addressed after the presentation. To those who are on Facebook, please enter your questions in the comment section. And now, without further ado, here's our host, Mr. Yan Lam.
Good evening, everybody. Thank you so much, Connie, for that wonderful, warm introduction. And tonight's topic, guys, is going to be be the bank and how to make your money work for you. First, I want to apologize for last week. We usually will have our meetups and our webinars on the second Wednesday of every month, but unforeseen circumstances did not allow me to conduct that meeting, so we postponed it to today. And I know a lot of people who wanted to see this presentation, we had a conflict in their schedule because of the schedule change, but we will have this on Facebook. It will be posted there for forever. So if you guys ever need to review this information, feel free to go to our Facebook page and then go to that recording and you can reference it from there. Okay. So guys, we do this every month. Every month, that's a different topic with regards to real estate investing and different facets of real estate investing. And today, it so happens to be how to be the bank and how to make money work for you. We've been investing in real estate for the past 11, almost 12 years now. And as a father of five, it's a true blessing to be able to do your business, do something that's tangible where your children can see progress on what's being built, what's being created. It's not invisible. It's nothing what to do with IT or coding or anything like that. It's something you can actually physically touch and it's tangible that they can see growing progress. And as you know, in this day and age, a lot of kids are on electronics nowadays, and so they see things virtually. But we're in a business where people can see things as they are in reality. So real estate's been a true blessing for myself, my family, and looking forward for my kids as they grow up to have that experience within from what we have learned that they will never get in school or even in college when they go to college. Okay. So with that, guys, let's go and get started. First of all, everyone I'm sure recognizes this board right here. This is the Monopoly board, all right? And so the strategy for winning Monopoly is very, very simple. Everyone gets a piece, you roll the dice, you go around the board, you start buying properties. But the ultimate formula for beating the game is 4 greenhouses, red hotel. Once again, 4 greenhouses, red hotel. And that's all you do. That's how you beat the game eventually, right? So no matter if you're the shoe, the hat, the battleship, the dog, the thimble, the car, or the iron, or whatever you are, if you can get 4 greenhouses and red hotels and all the properties you buy, you eventually will win and choke the rest of the players who are unable to pay their rents as they land on your properties. Okay, so but regardless, no matter what piece you are, all right, who always wins, guaranteed 100%, and that is the bank. The bank never runs out of money. If the player is short on money, they need to pass go to collect $200. Guess where they get that from? The bank. If the player is short on cash and need to sell the houses that they have in the property, guess where they get the money from? The bank. If they have properties with no house and need to mortgage the property to get some money out, guess where they get the money from? You named it, the bank. Okay, so the bank never runs out of money. The bank always wins in any scenario in Monopoly. Okay, and we want you guys to learn how to be the bank so that way you can be the same thing in the game of Monopoly. So how do you become the bank? Okay, first of all, you want to identify all your funding sources. Where can you get money? A lot of people are a little close-minded when it comes to where to find money because they're so used to just looking in their savings account or looking in their money market account or their 401k. That's all they look at. But there's so much more accessible cash if you become resourceful. Now, the first couple here is very, very obvious. You obviously you have cash, whether it be in the bank or on hand. You have your 401k, your retirement accounts. You have your individual retirement accounts, your IRAs, Roth IRAs, traditional IRAs, whatever retirement accounts there are. That's accessible cash as well. All right. But did you think about getting home equity? Maybe you own a house right now. You've owned it for the last 10 years, 15 years. I'm sure there's some equity right now where you can tap into. You can get a home equity line of credit. All right. Or maybe your credit card accounts. Most people undervalue the credit card accounts. So if you have 5,000 here, 10,000 there on each credit card, it adds up. Okay. And you can get access to that cash through multiple means. So, you want to identify the sources of cash, and then you want to identify the cost of that source. So obviously, if you're borrowing from your own cash, there's no cost to that. If you're borrowing from your 401k, there is a cost associated with that. If you're borrowing against a home equity line of credit, there are costs associated with that. If you're borrowing against your credit cards, guess what? There's also a cost associated with that. So you want to identify the source and identify the cost for that source. All right. So, excuse me. So for the bank, there are two ways to make this work. Two approaches. We'll go through the first one. We'll go through the first one first, okay? So number one, develop all the processes, procedures, and team to invest your money like a real private bank. All right. So this will involve you needing an attorney. You need to develop an underwriting criteria. So you think about how loan officers approve a mortgage. You have to think of that mindset. You also want to understand market values and renovation plans, so that way you don't over loan or over leverage yourself on a particular deal. You need to manage renovation draws. All right. So as your investor does a fix and flip deal, you need to see what the milestones are, what progress they've made, so that way you can release the next portion to give for them to continue their renovation project. And of course, you need to comply with regulatory requirements. So if there are commercial loans, there's very little regulations. But if you're going through higher loan amounts and higher things that's more visible, you may need to work with the Security and Exchange Commission to make sure that you're doing everything legally and legit. Okay. So here's the process from a visual perspective. First, you have yourself, the lender. And of course, you are the one with the magnifying glass that reviews the deal. You're also going to review the rehabber, the fix and flip investor, to see if they have a past performance, if they've done this before, if they're experienced, if they're new. And of course, you want to evaluate the property to see if the value is there after it's been repaired. Will they be able to sell at the amount that they said they're going to sell it at based on the renovation plan? All right. So, as a part of underwriting requirement review, you're going to take a look at the experience of the rehabber. You can look at their liquidity. Can they sustain a rainy day? All right. You want to pull the credit report to see what they owe and what the credit score is. All right. Look at the renovation plans, and then also what's the credibility of the contractor that they're using. And then you want to take a look at the draw schedule. Then the property, what is the as is value if you did nothing to it? All right. And then what is the after repair value, and how's the title work? Is it clean? Are there problems? Do they need to do some things to clear out the title? And then you want to account for desirable and undesirable factors. All right. So things like a busy street, or maybe it's back to unsightly things that is not back to woods. There's no privacy. So there's some desirability things that affect value as well. And you as a lender need to understand that before you loan the money and put your money at risk. The bank should never lose money if you do it properly. All right. The bank only loses money if they put their money in an investment that was not sound. So you want to follow your underwriting criteria to make sure it's sound and it's almost a no risk investment for you as the bank. All right. Now, once the loan is approved and settled, you need to manage the monthly interest payments. You got to inspect the property for milestones in progress, issue renovation draws, continue with all this until the property actually sells. All right. And then you want to issue the payoff to the title company and wait for the wire once it's ready for sale. And then issue a 1098 form at the end of the year to the borrower, showing that they paid interest to you for that loan. The typical hard money lenders charge the following rates between 6 and 10% and 1 to 3 points, all right, depending on what's going on, how much risk is involved. And of course, there's more risk, the more expensive the money. The less the risk, the least expensive the money, and that's the name of the game. All right. And so the what are the risks to you as the lender? The borrower may get into a financial hardship and default on the loan and unable to finish the project for whatever reason. All right. Or maybe the borrower files bankruptcy. Renovation goes over budget with schedule delays, and the local jurisdiction may not approve the permits and work done. So there's some risk there as a lender, but if you underwrite it properly, to where there's equity in the property and you're not over leveraged, you should still be safe, because if the borrower does not perform, you can always take the property back and either finish it yourself, or you can then do a foreclosure sale to another investor and get your money and principal out of that property. So is it really worth it? All right. So you want to ask yourself, after doing all that work, is it really worth it to earn that 6 to 10% and 1 to 10 points? All right. So just think about it. On a $100,000 loan, 1 to 3 points, all right, is between $1 and $3,000. 6 to 10% per year is between $6 to $10,000 in interest. You do the math together, you ask yourself, is it worth it or not to do this deal, to risk your $100,000 to get maybe that much percentage back at the end of the year? So That's a question that only you can answer, yes or no. All right. So that's the first approach. All right. Here's the second approach, and my preferred approach. All right. Second approach, instead of building all those systems from scratch on your own, and that needs to run a private bank, you can commit your funds to somebody that already has built the infrastructure to keep your funds safe. You can commit your funds to a credible firm who has done this, who has the investing experience and has a large network of investors who can deploy the funds. And also understand how the funds will be deployed when there is a deal. So you being the lender, you can invest your capital into our capital company called Fortune Homes Capital. All right, and what we do is we have a quality process in place to where the money is not only protected, but there's an approach to where there's long-term growth. All right, so in the acquisition, you see on the left hand side here, there's the hard money lenders, which is what we are. You go through the acquisition, and then you go through the value add financing. All right, but then along the way, we require our borrowers to use specific contractors that we know will be able to do the property correctly. We also recommend certain licensed real estate agents who know how to sell and renovate it properly. After 11 of 12 years doing this business, I know for a fact that if you hired the wrong contractor or the wrong agent, you are messed up. All right. You will lose money, and you will have a very stressful deal on your hands if you use the wrong people on your team. So we already have a network of people who know exactly what they're doing and can protect you from those catastrophes. All right. We require our borrowers to use those people so that way there's less risk for us and less risk for you as the capital investor. We're currently offering returns between 5 to 7% and also profit sharing. Okay. So right now, if you, even though the Federal Reserve increased interest rates 5 times this year, the interest rates is still not all that exciting in the savings account. All right. I still haven't seen anything exciting that's above 1% or 1.5%. All right, so you have $100,000 to $200,000 collecting 1% or 1.5%. That's not exciting. It's not even keeping it with inflation. All right, so we're offering 5 to 7% guaranteed fixed return on your deal, on your capital, plus profit sharing. All right, and the profit sharing has to do with how the deal performs. So if the deal performs well, you get more of the profit sharing. If the deal performs kind of not too well, you get some profit sharing, but maybe not as exciting. Okay, so we want to pick and choose the deal that we're offering, and then you can see how much returns you have. So we have three different products. Product A, B, and C. The first one is a single unit rehab or a rental, where you commit your money up to 1 year to do the deal. You're in it. The borrower fixes up the property to either rent it out, refinance it, and rent it out, or they will sell it for profit as a fix and flip. All right. So either way, whether it's a refinance or a sale, you get the money out of there to back in your bank account plus the returns, or and you can use that money now to the next deal. Next is a product B, where you can go ahead and do a land development or a condo conversion, where it takes up to 2 years. And then letter C, product C, is a multifamily building where there's continuous rents coming in while there's a value add going on for each unit in the building that may vacate and go over. So if there's 100, 200 units in a building, every month there's going to be people who move in and move out. So while they're moving in and moving out, there's going to be a renovation process for those vacant properties, units, to renovate the kitchen, fix up some things to increase the value, so that way they can increase the rents for the newer tenants. That's a 5-year process to complete the entire building. All right. So there's cash. The good thing about that, though, is that there's cash flow. You get quarterly checks from the rent every 3 months, and then at the end of the deal, you get equity growth check plus your principal back along the way. So that's the value of product C there. So all these things here, by the way, are for illustration purposes. All right. Actual results will vary based on the performance of the actual deal. So, how can you invest? All right. One of the things I learned about multi-billionaires is that they teach you that you never should undervalue how much you're worth. That means your assets. Some people only look at their bank accounts, like I said, or maybe some their 401k, and that's the number they have in their mind of how much they're worth. They never think about anything else. But do you think about other things? All right. Your home equity line of credit, your 401k, a self-directed IRA, other retirement accounts, or maybe a life insurance policy that you can cash in on. All right, or maybe people that you can borrow money from, and you can build up your nest egg of capital investments to be able to do a particular deal. So there's a lot of different ways to raise money for yourself personally and those around you. Okay, so now let's go through a couple of examples. Okay, I love the idea of sharing guys the theory, but I also love sharing the examples to show how people have made money with us and how you can make money with us at the same time. So here's the deal. This product A is a single family rehab, 1 unit. This person invested $245,000 for this deal. He earned a 6.5% fixed interest rate over 7 months, which equals $9,300. All right. And then he earned a profit sharing based on the performance of the deal for a total of $16,000. So his total return on $245,000 investment was $25,000 and change over 7 months. If you do the math, that's a 17.7% return on their investment. Is that better than 1% for this from the bank account? Absolutely. Does it beat out inflation right now at 6% or 8%? Absolutely. So the name of the game in today's economy is that you got to get ahead of inflation. The more you keep it in savings, the more you're going to lose. Especially when inflation is high as it is right now, you're just going to simply lose value of your money that you worked for faster. So you want to go ahead and make sure that you can stay ahead of inflation and invest in wise investments such as real estate, because that is a tangible thing that will never lose value over time. All right. So that's product A as an example. Here's an example of a product B. All right. It's a condo conversion. You'll see here that there's a red and white row house right there in the middle. This is the back of the property. And right next to it, you'll see a building that has 2 units. So this property here that's red and white is actually going to be demolished and built the same way as the house next door to have 2 units. So that's a bigger project, takes much longer to get the permits and also do the actual construction. The capital investor who did this deal was invested $400,000. They earned 7% over 24 months, which equals $56,000. The profit sharing of the fund was $65,000 in total. All right. And the total return was $121,000, which gives an effective rate of 15.2%. Is that better than a savings account? Absolutely. All right. Now, this deal did not turn as much of a return as the other one, which was 17%. But here's the great thing about this one: the investor for this one did not have to look for another deal for 2 years. That money performed for 2 years straight without them shopping around for another deal. Whereas the first one had to shop around for another deal after the 7 months was over, and there was downtime where the money was not earning any returns. All right. So there's always downsides and upsides to long-term investments versus short-term investments. All right. Now, here's an example of a product C. There's a deal that we did out in Dallas, Texas. It's 111 units, and we raised through multiple capital investors an amount of $2 million. We were paying a fixed rate of 6% from stabilized rents. But the equity growth for $2 million over 3 to 5 years added to the profit sharing of the deal, which yielded a return of 15.7%. All right. So likewise with this one, it's across 3 to 5 years. So the people who invested in this deal did not have to shop around for another deal because they're earning this throughout the entire term. All right. Short-term investments, you need to shop pretty often. Long-term investments, as long as you don't need the money anytime soon, you don't need to shop around for anything, and your money continues to perform regardless if you do anything or not. All right. So less work, more returns. It's a happy day for everybody as a capital investor. All right. All right, so we got two approaches. The first approach is the act becoming the actual bank and creating all the procedures, building your team and doing your own due diligence and having the experience. And then the second one, simply be a depositor to a bank like ours. Let the bank do all the underwriting, use our experience to mitigate the risk, use our team of experts to ensure the investment is safe, and collect interest payments and profit sharing passively with little worries. So two approaches you guys get to choose, okay? So in particular, we actually have a deal available right now for those who might be interested. We have a product B available. This is a property located in Northwest DC. You'll see on the upper left corner, that's a picture of the existing property, what it looks like now with a blue front and red brick side. We are going to convert that into a 2 unit condo conversion. So on the right hand side, you'll see an architectural rendering of what the house is going to look like. So we're going to build a third floor, we're going to build a basement, and we're going to build a bump out. So that way each unit has about 2,400 square feet. And that's a lot of space in DC. So that property is going to sell at top dollar. And we're very excited when that's done. Right now, we're looking to raise $150,000. The status of the property is that we currently own the property. We currently have permits on the property, and we're looking to raise $150,000 to be able to jumpstart the renovation, so that we'll get to the first phase before our lender can reimburse us from the for the next milestone. All right. In terms of the investment, 18 months, but we think it'll be much sooner than that. So we like to say 18 months as a cushion. just in case we need it longer. So the minimum investment is $50,000, what we're looking for, but you can do the whole 150, or you can do $50,000 between three people. It doesn't matter, but we're looking to raise $150,000 in total, and the deadline to raise capital is the end of the month here on October 28th. All right. And if you guys are interested, anyone here on this meeting is interested, feel free to email me directly at info@fortunehomesteam.com. Let me know about this deal, about the $150,000 investment, and I'll give you more details via email. We can talk online and via Zoom and give you more details on how to proceed forward if you're interested in doing that investment. All right. So with that, guys, I want to stop right now to see if any questions or any comments about this topic here. So feel free to type in the questions on the chat or type in the questions via Facebook right now. All right. And as you guys are typing questions, one of the things I love, guys, about being the bank is that you get to earn money passively. So it's like having your money work for you instead of you working for money. All right. If you have a 9 to 5 job, you literally have to physically go to work to earn money. But once you have the money in your account, you can now take that money and have that same money work for you. And one day, when you have enough of that money working for you, you no longer need to work for money. Okay. So it's a whole transition process of working for money and then having money work for you. And by the time you retire, when you're 65 or 67 years old, or whatever the retirement age is nowadays, is that you may not even need to depend on Social Security or a retirement account anymore, and simply live off the returns that you have built in your nest eggs because of your capital investment. You're wise with your money, and you have your money work for you. And that money working for you, by the way, you can leave that to your children or any of your families long after we've left this earth. Now, one thing I can guarantee: no one's going to leave this earth alive. Right? We're going to go at some point in time, and the accomplishments that we have accomplished during our lifetime can be passed on to our future generations and our family tree. All right. So it looks like we have no questions here. But if you guys have any questions, feel free to type in the Facebook comments later on, and we'll definitely get those questions answered later on down the road. But next month, guys, I'm very excited about our last topic of the year. This will be the last webinar of the year. All right. So you definitely want to take note of it. On November the 9th, we're going to go through asset protection and tax advantages. Okay. So there's going to be a little button that comes off shortly. There's a red button right there. Click there to RSVP. And you want to click that now, so that will secure your spot, and you can get reminders to make sure you're on there, and you don't want to miss this one, because once you build your business, you want to protect your business, and that's what we want to teach you, from asset protection and also keeping the money from tax advantages. Okay, so don't want to give all your money away to paying taxes. We want to show you the different strategies on how the wealthy people pay as little taxes as possible legally, so that way you keep more of it in your pocket and reinvest it to grow it much more longer down the road. So with that, thank you so much for joining me tonight. Hope you enjoyed the topic. We'll see you guys next month at the same time on November the 9th about asset protection and tax advantages. Thank you very much, and have a great night.